Assalamualaikum warahmatullahi wabarakatuh to Professor Dr. Zuhaili Hasnan. Today, me and my group mates from AC703 F1 will be presenting on the real world case study project. The company that we chose is Ocean Cash Pacific Berhad and Air Asia X Berhad. Presenting our team members, my name is Nur Izzati binti Mansur, Nurmawati binti Rosli and Muhammad Bazli Fakri bin Bakri. Now I will pass the floor to Nurmawati to explain on the background of the company before we go into deeper discussion on other aspects of analysis.
Now, let's take a look into the background of the two companies to get better understanding of their business operations so that better analysis can be done. First company is Ocean Cash Pacific Berhad, which is a listed company in the Bursa Malaysia Stock Exchange. It is a company that holds investment as well as providing the management services, which their headquarters is located in Bandar Baru Bangi. The company is co-founded by Mr. Tan Siew Chin and Mr. Loh Pong Kiat, which it started in a rented space as a small resonated felt and non-woven maker. It then have grown bigger since it has become one of the top suppliers in the Southeast Asia. It is also due to its ability to address rising demands on the hygiene and automotive industries. Second company is Air Asia X Berhad, which is in the airline long-haul division. It is a Malaysian company with the goal to provide low-cost airline service, which registered office in Petaling Jaya, meanwhile their headquarters is located in Kuala Lumpur. Its ability to keep it as a low-cost airline by using a universal ticketing system. Being a low-cost airline company, they are still able to be the Malaysia's largest airline that offers both domestic and international flights to over 65 locations in 25 countries altogether.
Next, I will be discussing on horizontal analysis. As you can see, this is horizontal analysis for balance sheet. Since the restatement of the company is on 2016, so we take 2014, 2015 and 2016 as the base to analyze. This is horizontal analysis for income statement. So based on the calculated data of horizontal analysis, we can see that percentage of property, plant and equipment decreases from 32.48% between year 2014 to 2015 to 4.24% between year 2015 to 2016. The increment in 2014 to 2015 is due to major acquisition of plant and machinery from 648,464 ringgit to 13,563,113 ringgit. While from 2015 to 2016, there is a slight increase in acquisition of plant and machinery from 13,463,113 ringgit to 16,334,489 ringgit. This is the reason behind the downward trend in property, plant and equipment. Next, it is observed that cash and bank balances showed an upward trend. There's an increase in cash and bank balances from negative 6.4% between year 2014 to 2016 to 32.52% between year 2015 to 2016. In addition, deferred tax liabilities falls from 9.54% in 2014 to 2015 to negative 19.13% in year 2015 to 2016. A deferred tax liability is a line item on a company's balance sheet that represents taxes that are due but not payable until a later date. The liability is deferred due to the time gap between when the tax was incurred and when it is payable. In addition, loans and borrowings in current liabilities increases to 28.59% between 2015 to 2016. The drastic increase in loans and borrowings in current liabilities is because of bills payable, roughly from 8 million rise to 11 million ringgit. the bills payable bear interest at rates ranging from 1.68% to 12.25%. Next, revenue increases gradually from year 2014 to 2016. Percentage increasing of the revenue earned between year 2014 to 2015 is 9.09%, while there is a slight decrease in revenue earned from year 2015 to 2016 of 5.36%. The increase in revenue are mainly because of sales of non-woven products and sales of resonated felt for heat and sound insulation, which happened to increase gradually from year 2014 to 2016. The same thing happened to interest income. From 2014 to 2016, interest income decreased. This ongoing drop in interest revenue is the result of rising higher purchase and other loan expenses. Apart from interest income, dividend income has been declining from 2014 to 2016. It falls by 54.39% between 2014 and 2015 and by 37.17% between 2015 and 2016. The company's operating profit has progressively increased over the last 3 years, with a percentage gain of 54.18% from 2014 to 2015 and a small increase of 5.15% from 2015 to 2016. Next discussion, we proceed on vertical analysis. As you can see, this is vertical analysis for balance sheet. And this is vertical analysis for income statement. So based on calculated data of vertical analysis, we found that total of non-current asset, the percentage increases from 59.03% in 2014 to 65.51% in 2015. However, there is a slight decrease by 4.76% towards 2016, which make it 60.75%. The major contribution for the increment in 2015 is because of the drastic increase in the company's property, plant and equipment, which involves acquisition of motor vehicle, plant and machinery and some factory equipment. The company's total current asset falls from 40.97% in 2014 to 34.49% in 2015. Despite the downturn, the total current assets for 2016 increased to 39.25%. The decrease in percentage for 2015 is mainly because of other receivables, deposits and prepayments, which make the highest percentage difference by 2.14% between 2014 to 2015. The amount of deposits and prepayments for 2015 fall from 2014, while other receivable increases by 119,000 ringgit and 153 ringgit. The same trend occurred to the total equity of Ocean Cash Pacific Berhad. It falls in the second year 2015 and rise back in 2016. Reserves increase gradually from 2014, which is negative 44.87%, 2015 of 47.36% and 2016 of 51.21%. The increment in reserve is described by the rise in foreign currency translation reserve by the difference of 791,265 ringgit in 2015 and 611,139 ringgit in 2016. The foreign currency translation reserve is made up of all foreign currency disparities resulting from the translation of financial statements of foreign operations whose functional currencies differ from the group's presentation currency. Apart from the foreign currency translation reserve, distributable retained earnings also increases gradually for these 3 years. In addition, total liabilities of Ocean Cash Pacific Berhad also fluctuates, where in 2014 it results in 27.14%, 2015 rise to 28.48%, while in 2016 it falls back to 27.22%. Besides that, we also observe that gross profit also fluctuates. In 2014, it shows a percentage of 19.41%, then rise in 2015 to 20.73%, and lastly it falls back to 19.75% in 2016. As being calculated in 2015, the cost of goods sold was just 79.27% out of the company's total revenue. However, in 2016, the percentage has jumped to 80.25%. This indicates that the cost of goods sold has risen and is out of step with the growth in sales. Moreover, operating profit also fluctuates, as in 2014 shows a percentage of 9.73%, increase in 2015 to 13.75%, then falls back in 2016 to 13.72%. Second last is profit before tax. The subsequent increase of profit before tax are being explained by percentage of 8.94% in 2014, 12.36% in 2015, and 12.47% in 2016. The reason behind this is the fall of finance costs from 2015, negative 1.39% to 2016, negative 1.25%. Although the percentage of finance costs for 2015 slightly rise above 2014 by 0.61%, the operating profit for 2015 is higher than 2014, made them able to still maintain their performance. And lastly, profit for the year increased drastically throughout the 3 years, from 6.75% in 2014 to 10.98% in 2015, and lastly jumped to 12.17% in 2016. According to the analysis, Ocean Cash Pacific Berhad will be able to maintain their strong position in the coming years, since it is observed that their profitability is strong enough to pay the costs and expenses.
Next, we analyze Ocean Cash Pacific financial statements by using profitability ratio, liquidity ratio, and gearing ratio. Firstly, on profitability ratio, the operating profit ratio and net profit ratio both show an increase over 3 years until 2016, whereas gross profit ratio show an increase from 2014 to 2015, then decrease afterwards. This could indicate that the company able to maintain its business operation while generating profits. Next, return on capital employed. It shows that there is an increase then stable, which could also indicate that the company able to generate more profit in terms of capital employed. Secondly, on liquidity ratio, all these ratios share the same trend, where there is a decrease from 2014 to 2015, then an increased trend afterwards. Current ratio could indicate that the company is readily available to pay off its short-term debt obligations. Similar to asset debt ratio, this means that, excluding inventory due to its illiquid nature, the company is in a more liquid current position and able to pay off its debt. The cash to current asset ratio could indicate that the company has adequate cash among the current assets amounts, whereas the cash to current liability ratio could indicate that the company has more than sufficient cash to meet its short-term debt obligations. Thirdly, on gearing ratio, all these ratios share the same trend, where there is an increase from 2014 to 2015, then a decreased trend afterwards. The total debt to asset ratio shows that the business operation was not significantly financed by debt. In essence, it can be apparent that the first three ratios show a decline of debt obligation in comparison to asset and equity. However, for short-term debt to total debt ratio, there is an increased trend and of higher value, which could expose the company to liquidity shocks.
Now we will proceed in highlighting some red flags or possible fraudulent reporting items that might occur. First is revenue. From what we observe, The revenue of Ocean Cash Pacific Berhad shows a tremendous increase from 2014 to 2016, which is from 72 million to 79 million ringgit and jumped to 83 million ringgit. The calculations of revenues in notes of account states amount of sales of resonated felt for heat and sound insulation as the highest increment rate as compared to sales of non-woven products. Overstated revenue could happen since the company does not provide further details of the sales and only put the summarized calculation. Second is other income. The analysis shows a drastic increase from 151,155 ringgit in 2014 to 3,107,098 ringgit in 2015. The rise raised questions among us as there are no further details and explanation under that particular item. Hence, it could be as one of the red flags as there might be overstatement and fictitious income was created.
The third red flags will be on the trade receivables being overstated. It is found that the trade receivables has gradually increased from 2014 to 2016, which there is slight increase from 2014 to 2015 by 820,056 ringgit. However, between 2015 to 2016, it has drastically increased by 5,574,910. Even though there is a summarization of trade receivables being provided in the notes to the account, but there is no further and detailed explanation on the drastic increase except for the information on impairment. Thus, it can be a red flag of possible fraudulent reporting of overstating trade receivables amount, which might involve two situations like overstating assets and covering thefts of cash. As a result, revenues will be overstated. Fourthly, there is a red flag on amount owing to directors where it includes fees, advance, and payments made on behalf which are unsecured, repayable on demand, and are interest-free. Between 2014 to 2016, the interest rate was at a consistent percentage of 6.5. In reference to this, the amounts were all significant, which are million ringgit. However, in 2017, the amount dropped significantly to only 120,000 ringgit and with nil interest rate after the financial restatement. Such matters have been inadequately reported in the notes to the financial statements to explain about the purpose of allocating such amount during these periods.
The fifth red flag on tax recoverable. This amount is described as tax recovered from the government either due to overpaid or lost money in the previous year. There is a substantial increase in the tax recoverable figure from 2014 to 2015 by 831,032 Malaysian ringgit and from 2015 to 2016 by 467,003 Malaysian ringgit. The figure is treated as a current asset in the balance sheet. However, there is little explanation in notes to the financial statements that describes how the company receives the reimbursement amount that is significant in value. This could also indicate a red flag due to its substantial amount prior to its financial restatement.
Moving on to Part B, which comprises of intercompany comparison being done between Ocean Cash Pacific Berhad and AACX Berhad. The comparison is being done through ratio analysis, which comprises of liquidity ratio, solvency ratio, and profitability ratio. The first one is on current ratio, which is one of the liquidity ratio that measures a company's ability to pay for short-term obligations or those that is due within 1 year. Current ratio calculated for Ocean Cash Pacific Berhad and AACX Berhad are 1.95 and 0.6 respectively. Current ratio that is equal to 1 or less is considered poor since it shows that the company would be struggling to meet its short-term obligations. In this case, AACX Berhad will struggle to pay for its short-term obligations since it has only 0.6 current ratio, which is particularly lower than Ocean Cash Pacific Berhad as well as lower than being stated in the general rule. Next is acid test ratio, which is useful to indicate whether a company has sufficient amount of their short-term assets to cover all of its short-term liabilities. However, inventory will be ignored in this calculation since it may cause difficulties to liquidate those assets quickly. So, where a company with less than ratio of 1:1 would need to create more quick assets, since it indicates that the company does not have sufficient liquid assets to pay for its current liabilities. In this case, the acid test ratio of Ocean Cash Pacific Berhad is 1.42, while A Asia X Berhad is 0.46. It shows that Ocean Cash Pacific Berhad has better short-term assets amount to cover its short-term liabilities compared to A Asia X Berhad. Next is debt ratio. It is a ratio that being used to measure the capability and extent of a company's solvency, which will indicate whether a company is able to pay its long-term liabilities or not. Here, the debt ratio for Ocean Cash Pacific Berhad is 0.27, which is below the reasonable ratio of 0.5. It means that this company is considered stable and less risky because it is assumed that they are financing their company's assets through equity. However, for A Asia X Berhad, with 0.76, higher than the reasonable ratio, it means that the company is high leverage because they finances their assets using debt. Investors will preferably look for a company that have debt ratio between 0.3 and 0.6. So, it is assumed that Ocean Cash Pacific Berhad might have attract more investors than A Asia X Berhad. Next is debt to equity ratio, which is practical to measure the extent of a company's leverage to pay its long-term debt, which can determine the company's ability to protect its creditors when insolvency happens. For Ocean Cash Pacific Berhad, its debt to equity ratio is 0.37, while A Asia X Berhad is 3.25. This indicates that Ocean Cash Pacific Berhad is way more stable and has less risk compared to A Asia X Berhad. Next is equity to ratio. For this ratio, the lower equity to ratio indicates that a company is using more debt to acquire its assets, which is seen as an indicator of greater financial risk. It is also useful to indicate a company's way of generating its assets by the issuance of equity shares or by debt. Ocean Cash Pacific Berhad has 0.73 equity to ratio, while A Asia X Berhad has 0.24 equity to ratio, which means that Ocean Cash Pacific Berhad has better management on funding its assets effectively by using equity shares more than debt. Meanwhile, A Asia X Berhad is assumed to be relying more on its debt to generate its assets. This is not good since debt usually gives more of financial risk to any company. Equity multiplier. It is being used to determine the number of a company's assets that are being financed by the company's shareholders. In this case, the equity multiplier for Ocean Cash Pacific Berhad and A Asia X Berhad are 1.37 and 4.25 respectively. Ocean Cash Pacific Berhad has lower equity multiplier that indicates the company is doing better since it is less depending on debt financing. Meanwhile, A Asia X Berhad has higher equity multiplier that shows the company is relying more on its debt as the financing method, which will give more risk to the creditors and also to the investors. Next is net profit margin. It is usually being measured to determine the amount of net income generated with each dollar of sales while comparing to the net sales of that company. This is very useful for external users since it will provide them the information about the company's capability in running its business efficiently. So, if the company has an extremely low net profit margin, it indicates that they are financing their expenses at a very high cost, which the management should consider to rearrange and also reallocate the budget while cutting out unnecessary expenses. In this case, net profit margin of Ocean Cash Pacific Berhad is 12.17%, which shows that the company has high profitability ratio to attract the investors since it is generating sufficient profit from its sales as well as able to sustain a minimum amount of operating and overhead costs. However, the net profit margin of A Asia X Berhad is 5.25%, which shows that the company has lower profitability. Return on asset is used to measure the company's ability to utilize all of its assets to generate profits during the year. Percentage generated by the calculation of return on asset will provide the management and also the investors the information of how well the company is able to convert its assets, particularly investments, into profits. Ocean Cash Pacific Berhad has 9.85% return on asset, which is higher than AirAsia X Berhad that has 4.68%. Both of these companies are able to generate a positive percentage of its return on asset that shows their capability to manage its assets effectively, that which able to produce positive net income. However, in comparing them both, Ocean Cash Pacific Berhad definitely has greater capability to manage its assets in generating revenues and profits. Next is on return on equity. It is to measure the company's efficiency to generate profit. This will assist the investors to make decisions, since return on equity will show whether the company is a profit maker or a profit burner. In this case, the return on equity for Ocean Cash Pacific Berhad is 13.5%, which is less than the minimum acceptable percentage of 15%, while AirAsia X Berhad is 19.9%, which is more than the minimum acceptable percentage of 15%. Lastly is on the total asset turnover. Total asset turnover means that the company is able to generate sales through the amount of assets it owns, while also measures the efficiency of the company in using all of its assets. Here, the total asset turnover for Ocean Cash Pacific Berhad is 0.81 times, meanwhile AirAsia X Berhad is 0.89 times. Relying on the principle of where the higher the ratio, the better that the company is performing in utilizing its asset to generate sales. So, in this case, AirAsia X Berhad has higher total asset turnover at 0.89 times compared to Ocean Cash Pacific Berhad at 0.81 times.
Based on the ratio analysis calculated above, it indicates that in year 2016, Ocean Cash Pacific Berhad has appeared to be having a better performance compared to AirAsia X Berhad. Such intercompany comparison is being done by comparing ratio analysis of the liquidity, solvency, as well as profitability of each company. In conclusion, we can conclude that in terms of liquidity, Ocean Cash Pacific Berhad is worthy of investment rather than AirAsia X Berhad. According to the calculation, the current ratio and asset test ratio both proves that Ocean Cash Pacific Berhad has higher liquidity level than AirAsia X Berhad. This strengthens the company's ability to pay their short-term bills. The same situation goes on in terms of the company's solvency. In general, acceptable solvency ratios vary by sector, but as a general rule of thumb, solvency ratio of less than 20% or 30% is enough to be considered as financially healthy. Based on from the intercompany comparison ratio analysis, Ocean Cash Pacific shows a better solvency of mostly lower than AirAsia X. However, the situation goes vice versa when it comes to profitability of the company. AirAsia X has better profitability than Ocean Cash Pacific, as most of their ratio are higher. Profitability ratios demonstrate how profitability and effectively a business creates wealth for its owners. Although higher ratio results are often more positive, they reveal much more information when compared to comparable firms' results, the company's own past performance, or the industry average.